Well, as people start to trickle in, I just wanted to welcome you for being here. I know summer is very busy, so if you're watching the recording, um, thank you for watching the recording. If you're here in live with us tonight, we really appreciate taking time out of your summer to be with us here this evening. As I know this is a topic that people definitely want resources on, so we're going to send out the recording and then we will have some questions maybe at the end. Monique, does that sound good?
Yeah.
Okay. So we will have it recorded. We will send it out. Don't worry about that if you get cut off or need to jump off. But before we get started, just a quick, reminder as to why we're here. WealthShare REIT likes to put on webinars of all kinds of different topics. And the goal of these is to help you in your investing journey, to share what we are learning along the way, and to keep you informed and updated and help with your goals. And so tonight is another example of that. We did hold a Smith Maneuver topic before, and it was by far the most registered event we've ever had. So this is sort of a follow-up. I know it's the middle of summer now, so it's a lot to ask to be talking about a technical topic, but we're excited to be here tonight. And Monique Verlaan is here going to present for us. Monique is the WealthShare CFO and Smith Maneuver specialist and CPA, and her company Anchor Retax, as you can see her logo behind her, does offer Smith Maneuver services if you do need help with the Smith Maneuver strategy. And so, Monique, I'm going to let you take it away. I will manage the chat and the waiting room, and I'm going to pin your profile.
Okay,
There we go.
perfect. Now, I can't, nobody's got their cameras on or anything like that, and I'm just want to get a gauge of where everybody's at in their investment life. In other words, can I get a show of hands before you do? Natasha, how do I put it into, oh, there we go, gallery. There we go. All right. Can I get a show of hands of people using your emojis down at the bottom there who have rental properties?
Mhm.
One, two.
Thumbs.
Okay, quite a few. All right, quite a few of you. Who has a very basic question? Obviously, everybody's got a mortgage on their home. Who has a readvanceable mortgage?
Couple.
Okay, there's a couple. All right, probably Oscar. Hey, Oscar, nice seeing you here. All right, a couple of you. All right. And probably there's quite a few of you there that probably do not know what a readvanceable mortgage is, but don't worry, I'll go into that so that we have a clear understanding of what it is. Okay, perfect. Okay, so as Natasha mentioned, I am the CFO of the WealthShare Real Estate Trust, and I also have my own little company, and I'm the principal of Anchor Retax, where we specialize in Smith Maneuver strategies. So what we're going to do tonight is we're going to explore how your personal home mortgage, which is probably the most likely your largest expense, can become your most powerful wealth building tool. Now, the Smith Maneuver is a proven strategy designed specifically for Canadian homeowners. This isn't about adding more debt. It's about making your existing mortgage payments work harder for your future. And by the end of the session, you should be able to understand how to transform your mortgage from a burden into an opportunity, which is critical. Okay, perfect. So there we go. There we go. Right. So before we dive into the solutions, we need to acknowledge a couple of challenges that's actually facing us today. One of them is job security. It isn't what it was before, and many Canadians worry about their long-term employment. The other one is economic uncertainty has become our new normal, making financial planning a hell of a lot more difficult. Government spending priorities may not align with your personal financial needs. Tax burdens continue to increase for the average Canadian, and traditional pensions are disappearing, leaving us responsible for our own retirement security. And these concerns are absolutely valid and shared by many of us. you're not alone in feeling this type of uncertainty. So with these challenges, building wealth feels incredibly difficult. Inflation is a constant threat, silently eroding purchasing power of money and savings. Life expenses naturally increase as our families grow and our needs change. The cost of these everyday necessity continues to rise faster than our incomes. The tax burden, the wage growth simply isn't keeping pace with these increasing costs. And the tax burden on the average Canadian is now larger than the essential living costs combined. And for homeowners, mortgage and property costs take up a significant portion of income. And this perfect storm makes traditional wealth building advice seem unrealistic for many. But there's a strategy designed specifically for these challenges, and that's what we're going to be discussing this evening. Now, we've all heard the standard financial advice from experts, including our parents. Invest more. Well, as if we have surplus cash just waiting to be deployed. Max out your registered contributions. Well, that's a great strategy if you have the extra funds. Prepay your mortgage. Solid advice for reducing interest costs, and reduce your debt. Of course, less debt means more financial freedom. And this is fundamentally sound advice, and there's no argument there. But the problem isn't the advice itself, it's the underlying assumption. Now, here's the critical issue with traditional financial advice. All of these strategies assume you have additional money to work with. They require you to find extra income or extra room in your budget. And for most Canadian homeowners, this assumption simply doesn't match reality. And when your budget is already stretched so thin, finding that extra money feels literally impossible. And traditional advice doesn't address how to build the wealth when there's nothing left at month's end. And this is where we need to think differently from our existing resources. This is the reality for many Canadian homeowners. After covering essential expenses, there's often nothing left. The monthly mortgage payment alone consumes a significant portion of the income. Add in taxes, childcare costs, groceries, utilities, other necessities. Many families find themselves just breaking even or even worse. Traditional wealth building strategies falls apart when there's no surplus cash, and we need to have a different approach, and one that works with what you already have. So let's make this relevant to your personal situation. If you own a home, you already have the foundation for this strategy. If you have a mortgage, you're making a significant monthly payment. And for many, that mortgage feels like an absolute burden, a dark cloud over your financial future. You might wonder if you'll ever truly be free of this debt. But what if that mortgage could actually be the key to your financial future? The Smith Manoeuvre is designed specifically for Canadian homeowners like yourself. So let's look at an example. With a $400,000 mortgage at 4.5%, amortized over 25 years, at a 38% marginal tax rate, you will need to earn over $1 million just to pay for your mortgage. And this is a staggering amount, represents years of hard work, but it doesn't have to be this way. The Smith Manoeuvre helps reduce this burden significantly. And by making your mortgage interest tax deductible, you can save hundreds and thousands of dollars. So most Canadian homeowners share two primary financial objectives. First, paying off that expensive mortgage as quickly as possible. And secondly, preparing adequately for retirement. And these goals often seem to compete with each other. Traditional advice forces you to choose one priority over the other. But if you could pursue both simultaneously, how would you feel? The Smith Manoeuvre allows you to address both goals at once. And this integrated approach is what makes this strategy so powerful. Now, there's a hidden cost to the traditional approach of mortgage first, retirement later. If you wait until your mortgage is fully paid before investing, you will miss crucial years of compound growth. And those early investment years have an outsized impact on your final portfolio. So waiting 15 to 25 years to start investing seriously can cost you hundreds of thousands of dollars in potential growth. And this opportunity cost really gets factored into traditional financial planning. And the power of starting investments earlier cannot be overstated. Now, so you're stuck, okay? This creates a seemingly impossible financial situation for many homeowners. Inflation constantly erodes your purchasing power and wealth. Expenses continue to grow while wages remain relatively stagnant. Your mortgage consumes a significant portion of your monthly income. And after covering essentials, there's little, if nothing, left to invest. And high taxes further reduce your available income. You're forced to prioritize immediate needs over long-term financial goals in this instance. And this financial trap affects millions of Canadian homeowners. And it's not your fault. It's a structural challenge in our economic system, and it can lead to some pretty dire outcomes. So without a better solution, many Canadians face difficult choices in retirement. You might need to downsize and leave the home you've built a lot of memories in. Living on a small financial income becomes your retirement reality. Many find themselves working well past traditional retirement age out of pure necessity. Some turn to reverse mortgages, surrendering equity built over decades. These aren't choices anybody wants to make. They're compromises forced by inadequate financial strategies. But there is an alternative approach designed specifically for this challenge. And what you need is an integrated strategy that addresses multiple goals simultaneously. First, you need to eliminate costly non-tax deductible debt like your home mortgage as quickly as possible. Second, you need to reduce your tax burden to keep more of what you earn. And thirdly, you need to start investing for your future now, not years from now. The solution must work with your existing resources, not require extra money. It needs to be sustainable over the long term, not just a quick fix. And it must be accessible to every Canadian homeowner. And the Smith Manoeuvre is designed specifically to meet these criteria. So before we explore the strategy itself, we need to shift our mindset. Thinking like an investor means seeking opportunities where others see expenses. It means understanding the difference between good debt and bad debt. It means taking control over your financial future rather than being a passive participant. This mindset shift is the foundation for everything that follows. You don't need to be wealthy to think like an investor. You just need to look at your existing resources completely differently. And this perspective change is the first step towards financial transformation. Now, I want to introduce one of the biggest mindset shifts that separates everyday homeowners from true wealth builders. Not all debt is bad. Most Canadians carry non-deductible debt, things like mortgages, car loans, credit cards, and every dollar of interest on those debt payments is paid with after-tax income. And that's what we call wealth-destroying debt, because it costs you more to borrow and it gives you absolutely nothing back. But deductible debt is very, very different. Deductible debt is attached to investments, assets that actually grow and generate income. Because the interest is tax deductible, it becomes much cheaper to carry and over time helps build wealth instead of eroding it. Now, your home is one exception. Yes, it usually appreciates, but the mortgage attached to it still isn't tax deductible. So you've got a growing asset paired with the most expensive kind of debt. And that's exactly what we solve with the Smith Manoeuvre. The whole strategy is about gradually converting that non-deductible mortgage into a deductible investment debt, turning something that's been holding you back into something that can accelerate your net worth. Now, I want to highlight how investors view equity very differently from the average Canadian homeowner. Now, most people treat equity as something they save up and eventually spend down in retirement. But if equity is just sitting inside your home, not earning a return, it's actually giving you a negative rate of return, right? Because inflation is eroding its value every single year. Investors think of equity as a tool, not as a trophy. They don't wait 25 years to unlock it. They put it to work as early so that they can start compounding. And your mortgage is actually the gateway to accessing that equity. Every principal payment increases your equity position, and that equity can be redeployed into investments that grow and produce income and create real wealth for yourselves. So instead of consuming equity later in life, the investor's mindset is use it now while you have the time for compounding to do its job. And that's the core philosophy behind the Smith Manoeuvre, turning trapped, unproductive equity into an active wealth building machine. Now, here's the part that most people don't realize. This doesn't start years from now, it starts today. The moment you begin the Smith Manoeuvre, all of the benefits starts working at the same time. Your mortgage begins converting, your investment loan begins building deductibility, and your investment portfolio starts growing. The tax position starts improving. And these aren't sequential benefits, they're simultaneous. Everything begins working together from day one. And the best part, and this is where most clients breathe an absolute sigh of relief, is that it requires no extra monthly cash. We simply redirect the dollars you're already spending towards wealth creation instead of wealth destruction. And this is why this strategy is so powerful. It doesn't ask you to sacrifice your lifestyle. It just asks you to use the same dollars just a little bit more intelligently. All right, this slide walks through the full Smith Manoeuvre process step by step. And the key idea here is that everything works together in a continuous loop. Step 1, you get a readvanceable mortgage. Step 2, you make your regular mortgage payments, and this is the payment you're already making today, nothing extra, nothing new. And as you pay down the principal, your HELOC limit increases by the same amount. And this is the core feature of a readvanceable mortgage. Every dollar you pay towards a principal becomes available to borrow again. Now, step 3, you borrow from the HELOC and you go and invest it. Step 4, now that the debt shifts from non-deductible to deductible debt, and the investment loan starts working for you, and the interest on that loan now becomes tax deductible. Invest every month. Consistency does matter, and you're building a portfolio in real time using equity that would otherwise stay trapped in your home. Step 5, when it comes to tax time, your refund increases because your deductible interest grows each year. And the magic move is what happens next. Take that tax refund and prepay your mortgage. That extra prepayment reduces principal even faster, which frees up even more HELOC room, which lets you even invest even more. And then it simply becomes repeat, 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 repeat. And this loop continues until your entire mortgage is converted into a fully tax-deductible investment debt with a growing investment portfolio right alongside it. And the beauty of this process is that it's systematic, disciplined, and cash flow neutral. You're using the same dollars, but now they're building wealth every single month. So let's look at a typical mortgage, right? You've got a $400,000 loan, and everything in that loan is non-tax deductible. And as you're paying down that loan, that equity just sits there. That is a traditional, typical mortgage. But when we look at a readvanceable mortgage, you've got a $400,000 loan again. You're paying down the portion. That principal portion of that loan now readvances into your line of credit as available credit. And now you can use that line of credit to go and invest. So let's take an example. Your mortgage payment is $2,214. $1,486 of that is interest, but $728 goes to the principal. So it reduces your mortgage. And now this portion now becomes available credit on your line of credit. And you go and use that $728 to go and invest. And the investing is what becomes, what becomes available is the critical component of this whole Smith Manoeuvre strategy. So when we talk about using borrowed funds, the distinction here is very critical. And it's one of the average Canadian really, really understands. Borrowing to consume things like cars, vacations, day-to-day spending creates no tax deduction at all. You're paying interest with after-tax dollars, and the item you purchased is usually depreciating. And that's why consumer debt hurts your long-term wealth. But when you borrow to invest and you have a reasonable expectation of earning a taxable income, whether that's dividends, interest, or rental income, the picture changes completely. Now the interest on that borrowing becomes tax deductible. So the cost of borrowing drops, your tax position improves, and the debt starts working for you instead of against you. And this is the foundation of why the Smith Manoeuvre is so powerful. We're simply shifting borrowing away from consumption and moving it towards investment. So every dollar you borrow has the potential to build your wealth, not erode it. So coming back to the re-advanceable mortgage payment, you pay down your mortgage, gets re-advances into your line of credit, you go and invest it. And you do this every month. And as your tax refunds comes in, you use it as a prepayment of your mortgage, re-advancing your line of credit, you go and invest it. To the point that by the time you've actually 100% debt converted, your primary non-tax deductible debt is now being paid off. And now everything is sitting in your line of credit, which is tax deductible, which creates bigger tax refunds. And those tax refunds is money you would not have had if you did not use the line of credit to go and invest. So what's it worth? How much difference does the Smith Manoeuvre really make in doing this? It potentially can create hundreds and thousands of net worth improvement for yourself. There's a potential to that. And because it generates interest on its, because the tax deductible debt and generates income, it generates interest and is now tax deductible, creates tax refunds. You could potentially pay down your mortgage 3 years earlier just by doing that. And this is just the plain Jane strategy. This is just the first little strategy of the Smith Manoeuvre. You can actually improve this strategy by using accelerators. And using this strategy, no new cash is required on a monthly basis. You have just basically used the principal portion of your mortgage to go and invest. But if we use the accelerators, right, and there's a couple of them which I'll go through, your net worth improvement could be greater than $1 million, and you potentially could pay off your mortgage 18 years earlier or more. So I'm just going to touch on a couple of accelerators, and one of them is the debt swap accelerator. And the debt swap accelerator is ideal for individuals that have got investments already. And I'm not talking about RSPs or TFSAs because those are non-registered funds, and I don't like touching those funds for this type of strategy. But if you do have investments in non-registered funds, with mutual funds or anywhere else, and in this particular example, you have a $400,000 mortgage, you've got a line of credit, and you've basically got $10,000 in investments. When we do the debt swap accelerator, we basically say liquidate that $10,000, use the proceeds, use it as a prepayment on your mortgage. So your mortgage now goes from $400,000 to $390,000. That reduces the interest on the non-tax deductible debt. That $10,000 re-advances into your line of credit, and you borrow that, and you go and invest that $10,000 again. So now you're borrowing to invest, and that interest on that line of credit can now be used to offset the income that you've now generated on that $10,000 that you would not have had if you did not do this strategy. Another strategy is the cash flow diversion, and this is for individuals that are putting money away every single month. And in this particular example, again, we're using the $400,000. We've got a line of credit, and this individual is now putting $300,000 from their paycheck, and they're putting it into a non-registered fund every single month, very dutifully. What if we say to them, take that $300, use it as a prepayment onto your mortgage. That $300 will be made available into your line of credit, and you borrow from your line of credit and go invest that. That interest on that loan becomes tax deductible. Any income that you generate on that investment, the interest you can offset against the income that you generate, reduces your tax liability again. The one is a drip accelerator, and this is one that is not really touched on because it's not that impactful, in all honesty, and it does work for very big investors that have hundreds and thousands of dollars invested, and they're earning quite a lot of dividend income. For individuals like that, what happens is, with a drip, every single time when you invest in a non-registered fund, and you always got like a toggle switch and that says, do you want a drip? And that drip basically means that any dividends that gets issued just automatically gets reinvested into the plan. You don't get the dividends. It just automatically gets reinvested. What if we say, don't toggle that, rather get the dividends. And then what you do is you take the dividends, use it as a prepayment onto your mortgage, and that principal portion gets readvanced into your line of credit, and you basically go and reinvest it into the stock that they were going to do for you. So in other words, them taking control, you take control of it. That is the drip accelerator. The other one is prime the pump. And in this particular example is where you can't do prime the pump, is you're busy with refinancing, you've got an appraisal of $500,000, and you've got a $400,000 mortgage, which is 80%. So you've got $100,000 tied in equity, which you can't touch. But you do have a line of credit available. What happens if your house is appraised for $600,000 in this example? Once again, loan to value of 80%, you now have a mortgage value of $480,000. But your mortgage balance is $400,000, which means you now have $80,000 available to go and invest. You take that $80,000, you borrow it, and then you go and invest it. That is prime the pump, is taking a large amount of money out of a refinancing and going and investing it. The next accelerator is my favorite, and this accelerator is ideal for people that got real estate, rental properties. And I used this strategy myself, and I was able to pay off my mortgage in 3 years by just doing this strategy on its own. Now, in the traditional sense, is you have your primary home, you've got a $400,000 mortgage, you've got a line of credit, and you've got a rental property, and you're generating $2,000 worth of rental revenue, and you're treating it like a silo. You've got a particular bank account for your rental property where the rental income goes in and all the property expenses is paid out. What if we flip it on its head a bit? What if we take that $2,000 rental income, right, and we use it as a prepayment on our primary mortgage? That $2,000 gets readvanced into our line of credit. We now basically borrow that $2,000 and we put it into our rental expenses clearing account. And all our rental property expenses still gets paid out of that bank account. The only change is the rental income. We're using the rental income as a prepayment, but the bank account is still being used for the rental property expenses. The interest that you are incurring on that line of credit for your rental property expenses becomes tax deductible. And we all know that I've got to be honest with you, I have not seen tax returns. Majority of tax returns is always tax positive because the mortgage payments, the principal portion of the rental property mortgage is not tax deductible, only the interest is. So you will have a taxable income. This interest on that line of credit now gets used to offset that taxable income on that T776 form that you've just filed for that rental property. One of the most powerful strategies out there for real estate investors that got rental properties. So let's take an example of the plain Jane again. All right. You've got a mortgage payment of $2,214. The $1,486 goes to interest, and you have $728 available. We basically borrow the $728 in the line of credit, and we go and invest it. Now, when the following month comes, you pay your mortgage again, and $1,483 is interest, and you've got $730 available that goes into your line of credit. You're effectively going to borrow the $730, but you're just going to take $728 and you're going to invest that like you did last month. The remaining $2 is now used to pay the interest on the line of credit for $728. Now, month 3 comes, you pay your mortgage again. Now you have $733 available to go and invest. Once again, you just take $728, you go and invest that. You have $5 left behind, and that $5 is used to pay the interest for the amount of $1,458. And you do that the following month and the following month. Once again, you are not using any of your personal cash in covering this. You are just using the principal portion that was made available in your line of credit. So let's look at the cycle of benefits. You invest money you wouldn't have had available otherwise each month. You generate, sorry, I've got to move that out of the way so I can see what you see. You generate valuable and increasing tax deductions each month. You eliminate your expensive mortgage in record time. These benefits actually start now, not later, now. And they work simultaneously with all your strategies. And no new cash is required from you each month. Now, I have an opportunity to go through the calculator that Robson Smith does, and it's about 5 to 8 minutes. Can I see a show of hands who's interested in seeing the calculator? Yeah? Okay, there's quite a few of you. All right, so I'm going to play it, and then we come out.
Okay, due to time constraints, this is going to be a very, very fast demonstration of Smith Manoeuvre calculator. So once in, I'm going to give it a name, this scenario, and we're going to head to the calculator. You can enter various types of income. I'm going to throw in $150,000 of employment income. I've also got a rental property proprietorship, and it generates $36,000 in rental revenues per year. And it costs me $34,000 a year to service the expenses on that rental property. I'm also going to input that I have $30,000 of mutual funds invested. And I've also got a $10,000 emergency fund. And down here, we can see my marginal tax rate is 45.8%. I'm going to go to the next sheet. I'm going to fill in my house value at $750,000. The mortgage balance on that is currently $450,000. The interest rate is 2.9%. The amortization defaults to 25 years. On the readvanceable line of credit side of things, I've got a prime rate of 2.45 and a premium of 0.5% for a total of 2.95%. Next, I'm going to go to the fund page where we start to see results. I can throw in whatever I project my investment to grow at on an annual basis. We'll leave it at 8%. This is saying the very first month's mortgage payment leaves me $769 to invest. I'm going to go ahead and invest that all. Here's where we start to see some results. Taxation improvement, total deductions over the amortization of the mortgage of $109,000, which lead to total in tax refunds of $50,000. No amortization improvement yet. We'll see that soon. But a net worth improvement of $388,000 already at this point. Now here I can adjust the amount that I would accept from the lender. They're willing to lend a total of 600, but I can move that up or down and we can see the results change. I won't go into an explanation on this right now, but let's just say I only want to accept $550,000 from the lender. So we've seen a bit of improvement in the results. Here's where we'll see amortization improvement. If I apply my annual tax refund as a monthly prepayment against that, an annual prepayment against that mortgage, and also reborrow that to invest, we'll see amortization improvement and also net worth improvement here. 2.33 years saved off my non-deductible mortgage, net worth improvement up to $551. The debt swap accelerator, I've got $30,000 that I already inputted in mutual funds. I'm going to go ahead and debt swap that and watch the results here. The years saved and net worth improvement. There we go. 4.6 years saved, net worth improvement of $791,000. I'm not going to input any future lump sums. What I'm going to do is debt swap my emergency cash. I'm going to secure a line of credit, a personal line of credit that I'm only going to use for emergencies. Therefore, I can debt swap this cash. I can prepay my mortgage and then get it invested. And we're going to see further results here. Cash flow diversion. Let's say I have been investing $300 on a monthly basis. That's how I built up my $30,000 in mutual funds. So I'm going to go instead, apply that as a prepayment each month, and then reborrow it to invest. 5.42 and 869, it goes to 8.42, a net worth improvement of $1.164 million. Cash flow dam accelerator. I previously entered my rental revenues and expenses, and that works out to $3,000 a month in revenues and expenses of $2,833. If I implement the cash flow dam accelerator, we're really going to want to watch this one here. Instead of saving 8.42 years off that mortgage at this point, I'm saving 18.25 years, which means my original 25-year amortized mortgage is going to be gone in 6.75 years. Dividend reinvestment plan accelerator, I won't go there at this moment. Prime the pump accelerator. Based on the numbers inputted, apart from that non-deductible mortgage debt when I refinance into a readvanceable mortgage, I've also got $100,000 of immediately available funds with which I can prime the pump. So I can withdraw some, all, or none of this if I wish. But if I do, I'm going to get this invested immediately. So if I pull $50,000 of this to prime the pump, then we'll watch the net worth improvement go from 1.3 to 1.7. Now I've saved 18.5 years off my mortgage. I've received total tax refunds over the course of the mortgage of $145,000. And again, instead of 25 years, that mortgage has gone in 6.5 years. So this net worth improvement, this is net worth improvement, meaning I've got an investment portfolio of $2.21 million offset by 100% tax-deductible investment loan of $484,000, leaves a net improvement of $1.726 million. And the next screen here, that just shows the graph. The green line descending at 25 years to the x-axis is 25-year amortization. This blue line getting $0 is the reduced amortization of my mortgage. The red line over here is my investment portfolio. The yellow line is my total debt. And then I can view and print a report, which is going to summarize the results. It's also going to give me my instructions for the monthly process of the Smith Manoeuvre based on my numbers. So there you go, a quick demonstration of the Smith Man calculator. I hope you enjoyed.
Okay, that's the presentation. I hope that was of interest to everybody. I absolutely love this strategy. Everybody that knows me, I talk about it the whole time. It's just an awesome, awesome, awesome strategy. But I'm open to questions. Anybody that's got any questions, please go ahead. You can put it in the chat or you can just unmute yourself and just ask. Thanks, Darren.
Yeah, great job. Questions? In terms of tracking for the CRA.
Yeah, there's Well, it depends. It depends what bank you actually use, because if you are with Manulife One, you can actually use it. They've got a sub-tracking or tracking sub-account that can actually help you track it. But the bottom line is, Marina, you do need to track it. When you've got a rental property, you're tracking that already. You have to track the income, you have to track the expenses for those properties. So that is part of the tracking. Also, when you're using your HELOC, you do need to track it, especially if you're doing multiple investments, whether you're doing like a bit of a plain Jane strategy, or whether you're doing cash flow diversion of $300 towards an investment and you've got a rental income property. Well, then you're going to use your HELOC. You're going to use one HELOC, but the way it all gets structured with the different bank accounts, you're still going to need a HELOC tracker to say what was the purpose of the funds. Because one of the things that CRA always asks for is, what was the purpose of the funds? Right, I used the funds to pay for my rental property expenses. Great. How much did you borrow for your rental property expenses in a particular time period? Right, you've tracked that. I also used the funds to go and invest in non-registered funds. Great. You've got put that in the tracker. So you can actually use one tracker, one Excel spreadsheet, and you can do it by transaction date, by the amount, and the purpose of the funds, and then you can track the interest accordingly for that. Because as an accountant or your tax file or yourself, you can actually work out exactly what portion goes towards your investment and what portion gets allocated to your rental properties as a tax write-off.
I just put your anchor email in the chat, Monique, for people who want to
Get a hold of me.
get a
Okay.
consultation or set something up. Monique offers Smith Maneuver strategy. What do you call it? Support.
Yeah.
Make sure
I
you're
think,
doing it
Kevin,
right.
what's the best way to connect to get? You can just send me an email, Kevin. And I do guidance for that, for Smith Maneuver strategies, because although I am not keen for individuals to do this on themselves, because the strategy is sound, it's the implementation where it goes wrong.
Right.
And that is one of the critical failures where people have actually spoken badly about the Smith Maneuver, and it's purely because it's been implemented incorrectly, because people do not follow the process. Because one of the key criteria is if you look at the interest deductibility folio from CRA, paragraph 1.34, they talk about cash flow damming in that particular paragraph, but the key words there is segregation of funds. And that is the critical component, and that is part of your implementation process. And people that do this by themselves, by following YouTube or TikTok or Reddit for that matter, they're the ones that get themselves into significant trouble. And I get a lot of phone calls of trying to get them out of trouble with CRA.
Yeah.
So you can do it on your own, but it's the implementation and the structure of setting it up that is where things go completely wrong. But Kevin, by all means, get hold of me. We can actually go through what you've done and see that that you've implemented properly and that you're following the process properly as well.
Okay.
Marina, the name of that calculator is a Smith Manoeuvre calculator. Unfortunately, it's only available to us Smith Manoeuvre professionals.
Ian asked, what about the HELOC interest payment every month? How is that paid or factored in?
As I explained, it actually covers itself.
Covers itself. Yeah.
It covers itself. You actually
You
borrow
hold back a
to,
portion.
yeah. So
Yeah.
especially if you've got, Ian, you've probably got rental properties as well. You just basically move the money across, including the HELOC interest, and then the rental property expenses covers the HELOC interest payment for that.
I think this is one of those things. It's definitely better to get guidance and do it right and be tracking everything right. So yes, very much appreciate your time. And I know Monique makes this all sound so simple. And so breaking it down for your individual scenario is probably worth doing. So yeah, I don't think there was any other questions. I was going to comment.
And the nice thing about using this
Yeah, that was
strategy
it.
as well, for example, if you were doing prime the pump, or you were thinking of doing a bit of a debt swap. In other words, you've got $10,000 sitting in an investment portfolio that is not performing well. And what you can do, you can actually liquidate that and use the proceeds of that. And if it's not doing well, the chances of you making a capital loss on that investment is highly likely. Or you can actually look at your investment portfolio between capital losses and capital gains that nets off, and then sell off those investments because you don't care so much for them, and then use the proceeds as a prepayment on your primary home mortgage. And if you want to, you can actually invest that into WealthShare, or you can invest it into any other non-registered fund. And the interest becomes tax deductible. That's the nice thing about it.
That's the nice thing, yeah.
Yeah.
Ian,
Oh, Ian, you should not have done that. I could have been a solution to your problem.
darn, eh? Would this still work for me with the funds? Yeah, no.
And if you got the funds available, absolutely.
Okay.
If you've got the funds available, Ian, you can. If you've got a primary home mortgage and it's sitting there, in other words, you got the cash from the proceeds and you've got it sitting in a GIC account, right? What you can actually do is just take it out of the GIC, use it as a prepayment on your mortgage. That will substantially reduce your mortgage. The potential of you paying a prepayment privilege penalty on the mortgage, because every mortgage you've got prepayment privileges, and you can do up to 15 or 20% on the original principal value of your mortgage, and you might be over that. But if you work out the interest savings over the life of the mortgage versus the prepayment penalty you pay, it outweighs it. And when I was doing the cash flow damming strategy, I was going over my prepayment privilege every year for the last 3 years. And it used to cost me $334, but it saved me $5,000 of mortgage payment. I paid that $334 all day long, just so that I saved that $5,000. And you can do the same. Use the proceeds as a prepayment onto your primary home mortgage. Pay the prepayment privilege, reduces your mortgage payment immediately, and you'll see that your amortization period reduces dramatically. And then it will readvance. It's critical though. You need a readvanced mortgage though. And then readvance into your line of credit and go and invest it.
Yeah.
Make it work for you.
I find it interesting. I was a landlord for 19 years. I sold at the peak of the housing. You don't want to know what I bought my rental for and what I sold it for. I did very well.
You got a capital gain.
Yeah. And my home, I have no mortgage. I have a home equity line of credit. But I do a lot of sort of different investing. Like I have invested in renewable energy with solar. I invested with private REITs. But I also do a lot of option investing as well, selling puts, which I found very lucrative. But I'm just curious that the Smith Maneuver, now that I have, so to speak, no rental, no mortgage and everything this way. So I found it interesting to kind of hear maybe some possibilities that way too.
Yeah, and people that don't have mortgages anymore, you've actually got equity tied to your home right now that's doing nothing, absolutely nothing. And it's still worthwhile, still getting a mortgage on your home. It just, you don't have a mortgage per se. You just have the available line of credit to access, to go and invest and generate more wealth for yourself. Now, if you were using this strategy for the Smith Maneuver with regard to puts and options, you will have a problem using your line of credit for that, because puts and options is capital gains. It's not considered as taxable income. So whenever I talk to people about using this strategy, it has to generate 100% taxable income, meaning dividends, interest, and rental. Whenever you do capital gains, you're only getting taxed 50%. So you do not meet that criteria. Capital gains, you cannot borrow for the purposes of capital gains. And puts and options and holds falls in that category. The only time it changes is if you are actually in the business of doing puts and options. In other words, it's your job every single day. You start at 6 o'clock in the morning till the market closes, and that's all you do. Day in, day out, and you making money. Then you're in the business of doing this. Then you can actually borrow money for the purpose of doing that. But if you're doing this passively, in other words, I'm doing it and I'm going to leave it for about a week, 2 weeks, and then I come back to it because it's all subjective, that falls under the capital gains category.
So if you're doing this as a business, you have to register yourself and then,
Yeah.
Okay, I mean, that's a great point. I've been curious on that as well, because I've been doing the puts and option trading for almost a year now, but the put options has been phenomenal, and I do it every week.
Yeah.
Yeah, I do it every week, but to that point, that is some concern with the, CRA and what those buggers are going to say now.
But but the only drawback from that now as well is as soon as you actually as a business, then the whole income is 100% taxable. So you don't get the benefit of the capital gains anymore.
Mm,
So there's a trade-off. And that's when you start contemplating, shall I incorporate? Shall I not incorporate?
right. Thank you for the advice. I appreciate it.
Yeah, no worries. Once again, folks, I'm not providing any form of tax advice. I am just providing general commentary here. I have to put my disclaimer here to say, because I am a tax professional, but I am not providing individual tax advice. I do not have an engagement with you folks. So whatever I'm providing is for educational purposes.
Yeah. I think the mortgage component too is something that it can like take a bit to get set up. If you're not in that mortgage now, when your mortgage is up for renewal, this is what you can start looking at. Like I know I've talked to some people that like just signed and they're kicking themselves like they didn't know about this, right? So certainly, and the mortgage products out there, like some of the best suited ones, like you mentioned, Manulife, are not necessarily super common, like one of the major ones that you hear about and that
Exactly.
mortgage
I
brokers
mean,
recommend.
now, Manulife is actually ideal for the Smith Manoeuvre strategy. And not everybody qualifies for Manulife One. And the drawback with Manulife One is, yes, the interest rate is higher because it's a fixed interest rate. But whenever you've got a rental property and you're doing the cash flow damming strategy, the rate does not matter because you're paying down your primary mortgage as quickly as possible.
Right.
So, I always say to people, when it comes to my primary home mortgage, I don't care about the rate. I just want to know how quickly can I pay it down. The only time I do care about rate is for my rental property. Why? Because if I get a better rate, I get better cash flow, which means I've got more cash flow to put against my primary mortgage. So there's two lines of thought here on that. But when it comes to primary home, rate is not the be all and end all. The product is the most important concept here. So yes, the ones that work the best is Manulife One, BMO. BMO works fantastic with this. Scotia, TD. The only drawback about TD is because of the OFSI rules, the 65% rule. They also, if you've got a loan to value of 80%, not 100% of that principal portion readvances into your line of credit, only 81% does because of the 65% OFSI rule. And the same applies for any prepayments made. So when we look at TD, we look at TD as a last resort. If people that's got 65% loan to value or lower, then we'll look at TD, but otherwise preferably not. And then people that live in the East, Ontario, obviously you've got National Bank. They're actually not bad as well.
Ooh, that's a good question.
Oh yes, 100%,
Yeah.
Alcina, 100%.
That's the
It's
best
always
time.
best to start earlier. My son is 23. He will be looking for a house early next year, and we are doing the plain Jane strategy with him on that. Yeah.
That's amazing.
What if your cash flow rentals are negative? Oh, and this is when we were going through COVID and we had those interest rates, and a lot of people started panicking. I've got to be honest, I was smiling. I wasn't worried. Yes, I was cash flow negative during that time period, but it didn't cost me one dime, not one, because I just used my line of credit to pay for the rental property expenses. So yes, I was cash flow negative for a very short period of time, but I didn't have to use my personal cash flow out of that. It all got covered by the HELOC. You can actually, if you're people that got condos, you 9 out of 10 times, and actually I would say 99% of the time, you will be cash flow negative with the condo. And right now, you obviously, you're putting extra cash in every single month into that rental account to cover the shortfall. Now, you can do a cash flow diversion for yourself in that particular case. So let's say, for example, you're $500 short every single month and you're actually paying that. Then use that $500 as a prepayment on your mortgage together with the rental income, and then the full amount readvances into the line of credit, and you can actually pay for the rental property expenses. Or If it's only for a very short period of time, like in our case, when we had rental properties over the COVID time period, and I knew it was only going to be for about a year to 2 years, then I just let the line of credit carry the can for that. I did not put extra money into my mortgage. I just let the line of credit because I had sufficient room in my line of credit to cover that. So there's a couple of options there. So whenever people are cash flow negative, I always say to them, please talk to me first because we've got a solution to your problem. And once it's paid, like mine is paid, what I'm actually doing is I'm taking the HELOC, I'm converting it into an amortizing loan. That interest on that amortizing loan will be 100% tax deductible, and my rental income will be covering the mortgage payments for that. And I'll carry on doing the prepayment privilege on that as well.
Mm.
So it's known as the Fraser Finagle. That's one of the 7th accelerator.
Finagle,
Yeah, it's a Fraser Finagle.
an
Yeah.
accountant term.
Yeah.
Maria asked one more on the cash damming, or did you answer that already?
On the cash damming, do you recommend stop paying the HELOC right away or just with the tax diversion? I don't use I use the HELOC to cover the rental property expenses. I actually prepay my primary home mortgage to create the space in the HELOC. But yes, if your mortgage is paid off, in other words, you don't have that monthly cash flow required out of your personal pocket. And that's a nice thing about 100% debt converting. It frees up my personal cash flow going forward. I don't have to worry about that after-tax mortgage payment anymore. You could leave it on a HELOC and then let the rental income pay that down the whole time. And you can start reducing your HELOC accordingly, especially if you're cash flow positive. Or you can do what I'm going to be doing, is doing the Fraser Finagle, take the HELOC, convert it into an amortizing mortgage again, but it's 100% tax deductible investment mortgage, and then use the rental income to pay for the mortgage payments going forward.
Awesome.
Okay.
Sure, there's more questions, but yeah, reach out to Monique for a consultation. Don't cut corners on this one. Don't
Yeah, please don't.
you don't want to play with the CRA. You want to do it right. We have investors definitely in WealthShare using the Smith Maneuver, which is cool to see. They've got investments trickling in through the year. And that's one nice thing about our low minimum. It does allow for a few options, but hopefully everybody got something out of this evening and for being here and joining us in the middle of summer, and that you learned something. And I think that's it. We'll wrap it up at the top there. And anything else, Monique, about getting in touch with you or anything else?
No, by all means, just bear in mind, I'm a bit slow because my office is closed for the month of July. We'll be back in full force again on the 4th of August. But please, if you want to reach out to me, send me an email and then we can take it from there.
Fantastic. Awesome. Well, really good to see everybody. Enjoy the rest of your summer. Thanks so much, Monique.
No worries.
Thanks,
And
everyone.
Michael. Good
Cheers,
to see
guys.
you.